Okay, let's dive right into this explainer. We're looking at why the upcoming big tech Q2 earnings are, hands down, the absolute most critical moment for the stock market this entire year. We're in a financial landscape right now that's completely dominated by artificial intelligence. But if you scratch just beneath the surface of all these record highs, there is a very specific, numbers-driven story playing out, and it's one that every single investor really needs to understand.
To figure out where we're headed, we actually need to look at what just happened. Just 3 weeks ago, South Korea's stock market, which, by the way, up until that exact moment was one of the best performing in the whole world, suffered a sudden, massive 25% drop. I mean, it was the fastest and largest drop in their market's history. Wealth was wiped out practically overnight.
Section 1. The Asian Canary. A warning from South Korea.
You really have to ask yourself, was this overseas crash just some isolated fluke, or is it a canary in the coal mine? To answer that, we have to look at how structurally vulnerable their market actually was. South Korea's KOSPI index, which is basically their version of the S&P 500, is supposed to be diversified. But in reality, just 2 AI-adjacent companies, Samsung and SK Hynix, made up over 56% of the entire index. Think about that. Over half of their market was essentially one giant, hyper-concentrated bet on memory chips needed for AI.
And when doubts started to creep in and those chip stocks started falling, it triggered something absolutely terrifying. Roughly 1.2 million retail accounts were hit with margin calls. Because these everyday investors had borrowed heavily to invest, some were even using highly leveraged ETFs, they were suddenly forced to deposit cash they simply didn't have. So their brokers automatically liquidated their stocks. This forced selling pushed prices even lower, which triggered more margin calls, creating this vicious doom loop that investors just couldn't stop.
Section 2. The S&P 500 parallel. Are the same conditions present in the U.S.?
So, are those exact same foundational cracks hiding right here at home? Now, on the surface, the U.S. market is incredibly deep, right? It's very diverse. But consider the actual numbers for a second. We might not be at that crazy 56% concentration level in just 2 stocks, sure. But having 37% of the entire S&P 500 tied up in just 10 mega-cap tech stocks, that is historically extreme for us. I mean, Nvidia and Apple alone make up almost 15% of the index.
The math here brilliantly illustrates a risk that is basically hiding in plain sight. A 25% drop in just those top 10 stocks would instantly trigger a 9% drop in the entire S&P 500 index. And remember, that is before any of the panic selling or margin calls even start. It just goes to show you how top-heavy the market has become.
Which leads us perfectly to the whole concept of leverage. Historically speaking, every single time U.S. margin debt has reached an extreme peak relative to our GDP, a major market correction is followed almost immediately. We saw it happen in March 2000, right at the peak of the dot-com bubble. We saw it again in July 2007, right before the financial crisis. And today, we're hitting a record 4.5% of GDP.
And that 4.5% of GDP translates to a staggering number, $1.5 trillion. That is the current record-breaking amount of borrowed money that investors have poured into the U.S. stock market. Now, when times are good, this borrowed money acts like rocket fuel, pushing stock prices astronomically higher. But when prices start to fall, this exact leverage is what creates the brutal, forced-selling doom loops we literally just saw in Korea.
Section 3. The $725 billion trap, the core fundamental issue.
So we have extreme concentration and we have extreme leverage. But what's the actual pin that could pop this balloon? It's this staggering projected figure, $725 billion. That's the amount of money big tech companies, we're talking Microsoft, Google, Amazon, Meta, are on track to spend on AI infrastructure in the coming years. Remember, one company's massive spending is another company's record earnings. This $725 billion is essentially the main pillar propping up the chip makers and by extension the entire stock market.
But we really need to look at the math that honestly nobody wants to do. The 5 biggest hyperscalers, those massive tech companies running the global data centers, are expected to spend roughly $534 billion on their AI buildouts through 2027. However, their projected operating cash flows from AI during that exact same period only expected to be about $340 billion. Breaking that down, it means big tech is currently spending $1.57 on AI infrastructure for every single dollar they get back in return. And why does this matter to you, the regular investor? It's simple. These companies are burning cash at a completely unsustainable rate. It is a massive, massive bet that assumes AI is going to deliver historic, world-changing returns almost immediately. And this brings us right to the make-or-break moment of the upcoming Q2 earnings season. What happens if just one of these trillion-dollar CEOs gets on an earnings call and says, you know what, we aren't really seeing the returns yet, so we're going to cut back our AI spending? If that happens, the earnings of the massive chip companies supplying them could just collapse. And if those tech stocks plunge, it could instantly trigger that $1.5 trillion margin call doom loop right here in the US.
Section 4. Bull versus bear case. Two very different futures.
Let's look at how this builds into two massive and completely conflicting predictions from Wall Street's smartest experts. On the bull side, you have institutions like Goldman Sachs targeting an 8,000 index level for the S&P 500. They firmly believe AI infrastructure will continue to grow rapidly and that corporate earnings will surge by 24% to easily justify these massive costs. But then, on the bear side, you have strategists mapping out a severe drop down to 5,400. They're warning that AI expectations are priced to absolute perfection, and if there is even a slight disappointment in revenue, the market is going to aggressively correct.
Because by almost every long-term standard metric out there, this is one of the most expensive stock markets in history. The forward PE, which measures current stock price against expected future earnings, sits at a slightly elevated 20.7. Meanwhile, the Shiller-Cape ratio, which adjusts for inflation over 10 years, is sitting up at 41. To put that into perspective, the absolute peak of the dot-com bubble was 44. So the market is priced for perfection, leaving very, very little room for error.
Section 5. Actionable investor takeaways. How to protect your portfolio.
So what do we actually do with all this information? Let's talk about what these macroeconomic indicators mean for your personal wealth and how you can position yourself safely without trying to perfectly time a market crash. Here are 3 grounded, highly actionable steps derived directly from this analysis. Step 1. Build a 3 to 6 month emergency fund in cash. If the market dips, you never want to be forced to sell your investments just to pay rent. Step 2. Diversify. Don't just own the top 10 tech stocks. Look at international markets, real estate, commodities, or alternative assets. And step 3, which is probably the most important lesson we can take from South Korea, avoid margin debt and leverage at all costs. Leverage is absolutely wonderful on the way up, but it will completely destroy your portfolio on the way down.
Even with all this potential volatility looming, history does provide us with some incredible reassurance. Yes, a 20 to 40% drop is incredibly painful to sit through for sure. But historically speaking, a 20-year holding period in the S&P 500 has literally never produced a negative return. If you have a long time horizon, the best strategy is very often just patience over panic. Just keep consistently buying the index.
I absolutely love this quote because it brilliantly summarizes a balanced, non-sensational approach. The market does not have to be a bubble to be dangerous, and it doesn't have to crash for you to get a good deal. You really don't have to predict the end of the world to simply practice good, disciplined risk management.
So I'll leave you with this final thought as we head into these highly anticipated earnings reports. Look at the numbers, closely watch the capital expenditure announcements from big tech, and ask yourself, are we witnessing the start of a massive, civilization-altering productivity boom, or are we looking at the peak of the greatest leverage trap in financial history? Keep your eyes locked on big tech's Q2 earnings, because we are about to find out. Thanks so much for joining me on this explainer, and I'll see you on the next one.